over to you, Sean.
Thank you, Diala. If we could bring up the first survey question. Thank you. Good morning, everybody. On your seats, you will see this piece of equipment which you can use in order to vote in the polling and give us your thoughts. I'd like to invite to join me Mr. Christof Rühl, the Global Head of Research at Abu Dhabi Investment Authority and one of the world's leading voices on the oil and energy markets. Thank you, Christof, for being here this morning. The first question, please, is one that inevitably leads off a lot of discussions around the coffee machine, and that's where is oil prices going? And that's the inevitable tea leaf reading. We didn't perform very well last year. As you can see, last year when we met, 92% of the audience voted Brent would end the year at $90, perhaps wishful thinking, but nonetheless it did end at $57.33. So everybody's out of a job and you can go home because you're not forecasting very well. Perhaps today we'll do better. What price will Brent be at the end of 2015? Basically on December 31st, where are we going? The trend has been very volatile in recent months, as Diala mentioned. I think over the last 15 months we've had 3 50% swings. So if we could all pick our clickers up on it, vote 1, 2, 3, or 4, and you can get your vote. Will it end the year in the 30s or lower? Will it end the year in the 40s, the 50s, 60s, and 70s? So whatever you think, press 1, 2, 3, 4, or 5. If we have the 10-second countdown, please, and we can see where the room is at. How confident is the room? How realistic is the room? We'll get a sense. People at Goldman Sachs are forecasting $20, others less pessimistic. Okay, so in the middle of the range, we're in the 40s at 38%, in the 50s at 36%. So essentially a tie between the two. Is that a surprise, Christof? When we last had this conversation in January, you were forecasting a lot of volatility. Obviously, that was correct. What do you think about this outlook?
I think it's not a big surprise. I think this basically is one of the questions which gives us pause to look back a little bit. When you look at last year's results, how far it was off. And I think it's a healthy reminder that you cannot really say anything about the future if you don't understand the past. And so I'll just take a minute. If you think what happened 1 year ago where we stood, we just came out of a period of 3.5 years of the highest oil prices ever for such a period, and of the most stable oil prices ever of such a period 1 year ago. And of course, most people thought that this tremendous amount of high prices and stable prices meant that the underlying market and the fundamentals were stable as well. But if you recall what had happened behind the scenes, where these two developments, a rapidly accelerating growth of shale oil production in the US, and really accelerating on a historic scale. So 2012, 13, and 14, these were the largest production increases in the US history, and the fourth biggest in global history, annual increase. And at the same time, it had zero price impact, because what we also observed over these 3.5 years was an almost unprecedented amount of supply disruptions. You know, think about civil war in Libya, which started it in early 2011, and then all these outages, sanctions against Iran, trouble in Iraq, trouble in Syria, trouble in Yemen. And it's really one of the most strangest things I have ever seen in economics or energy economics. If you plot this increase in production in the US against these supply disruptions in North Africa and the Middle East, they match each other for these 3.5 years, from early 2011 to mid-2014, almost barrel by barrel. The supply disruptions completely offsetting the supply increases. And so it was always the question that this is not a stable situation. That's an incidental match. And then the only question is, which side is the system going to fall off? In the event then in the summer, with a little bit of higher production in Libya and in Russia, it rapidly fell off the side of lower prices. And then another thing happened, which we should keep in mind for the future questions. By the time the survey was taken, this must have been before the November OPEC meeting.
Yes, it was.
So when prices came down, people still thought, okay, we'll have the OPEC meeting, they will cut a little bit and everything will be back to normal.
Yes.
Normal being $110 per year. And then, of course, OPEC didn't. And again, it was a completely rational decision, because throughout this process, they had lost market share. Most of these interruptions were in OPEC countries, and the US had gained market share. And at some point, you have to ask yourself, what am I going to do? And it was a true dilemma, right? Cutting production would have meant prices stay high, and the fast loss of market share would have continued at the expense of OPEC countries in favor of the US. Not cutting, and that will eat into your revenues. Not cutting production would have meant prices come down, also eats in your revenues, but it was rational not to cut production, to try.
Have you been surprised by the outcome, the calculation that OPEC met, that they would protect market share, but yet shale oil production in the United States has continued to grow? While we've seen the production rig count drop by half, production has continued to grow.
It has shown tremendous resilience. I remember a year ago, everybody's guess, I think, was that shale would suffer from about $60 and heavy oil in Canada would suffer from prices below $80. They haven't, and you're perfectly right, the rig count has decreased tremendously, production has not, and they have surprised in two respects. Number one, there is this old adage which many upstream people don't believe, but it's true, which is that in oil markets, costs always follow prices with a lag of 12 to 18 months. So if prices go up, you see costs exploding. If prices
supply
go down,
chain cost.
Yeah, for rigs, for labor,
right,
for capital, for steel, for anything you need, for other energy inputs. And in this case, as usual, if prices go down, the adjustment is fastest in the US because they have best market infrastructure. Costs went down tremendously as well, and more so than people suspected. The more important factor for this resilience is the second one, which is continued technology improvements. I think one has to be very clear. This is a new technology which led to the shale oil production possibilities, and the US were the first, and now they're reaping the benefits of moving to the frontier. And when we've seen that they have now possibilities of refracking, they have still local possibilities, because that's decided by the states, not the federal government, to optimize the distance between rigs. And they have technological improvements which have outperformed most expectations. And one of these things to which this has led is a new term in the English language. Have you ever heard the term frac lock?
Frac lock?
Frac lock.
No,
does anybody here know what a backlog is? A backlog is like my writing test, so there's lots of papers on it and a backlog because I can't get through them fast enough. Frac lock refers to the following. When costs for rigs came down and people started to shut down rigs and only run those which were most efficient, only those wells which produced most, a lot of them also then started to hire these now cheap rigs, and they drilled the wells but they didn't frack them. Right? And that's a frac lock, so they're ready to be fracked
when
as
the price
soon as prices tick up a little bit. And now what we have, of course, is shale is always different from conventional oil in the sense that its supply response is much more elastic, much faster. When prices go up, it will come back in no time. High OPEX, low CAPEX, and just not subject to the 7 to 10 year cycle which you have for conventional oil. And with the addition of frac lock, this depending on whom you believe, 3,200 to 3,700 wells being ready to go, this response will be even faster. We have never been there, so we don't know how fast, but it probably justifies the intuition of very high prices being very unlikely.
Well, let's go to the second question in terms of the outlook for volatility, which is obviously very relevant to this room in terms of trading. We've seen, as we said earlier, 50% swings since the plateau with the Chicago board. Crude oil volatility index averaging 44 this year, more than double last year. Do you expect a similar trend of volatility to continue over the next 15 months? If we can have the 10-second countdown, yes or no. Are we going to see a similar level of volatility over the next 15 months than we saw over the last 15 months? Which is okay, not a huge difference, but yet volatility, continuation of volatility is expected by most of the room, while there's still a significant percentage which is indicating that volatility will calm down. What are your thoughts on that, Christof?
Did you ask the same question last year?
No, we didn't actually.
Okay. I think
volatility was less present last year, hence the sort of doubling of volatility this year.
We did this horse and pony show, Truth and Advertisement, once before. In January, was it?
January, yes.
And we had this discussion, and yeah, I was convinced that it would be very volatile. when you step back again, the big picture, now you have two sort of cycles. You have the conventional story, which always happens. Oil prices crash down for one reason or another. And then you have the reaction, mostly first of private, large international oil producers, the Exxons and BPs and Shells and whatever of this world, cutting capex. Then you have a reaction in many countries to the same effect. But the effects of these cuts in expenditures will always only be felt 7 to 10 years away, because that's how long it takes to build these deep water production facilities and all that. That was the case in the early 2000s, when after the low prices in the 1990s, there wasn't enough supply there to accommodate this huge economic boom. Now, in addition, we have a shortwave cycle, which is the US shale production, because that, as I said, has a much higher frequency and a much higher capability to respond to lower prices, and so they will overlap. And I think one has to be very clear that in OPEC's policy calculus, it must play a role not only the short-term tug of war about market share with the US, which the press focuses on, but also the long-term effect, because the longer you keep prices low now, the bigger the payoff 7, 8, 9 years from now when that capacity is actually missing. That's the big picture. Now you zero in and you ask yourself, which other factors play a role? There's a lot. There's the unknown flexibility of shale response. There's the big question, will OPEC blink and when? Is it countries are burning through cash reserves reasonably fast, even if these cash reserves are larger than at any point in history? Other countries are, on the verge of risking social unrest because they can't pay their social programs
within
anymore.
OPEC, you mean? There's a variety of countries in OPEC.
You look at Venezuela, you look at Nigeria, you look at
Venezuela.
You look at Algeria also, these countries will be in trouble fairly soon. And so there's the question, will this policy be sustained and for how long? And then you have a whole lot of sometimes unexpected effects. Iran, everybody talks about, but more generally in a situation in the oil markets when prices fall, this could actually lead to an increase in supplies. Just think of it this way. Venezuela, before they go bust, they will pull all the stops to maximize production. Russia, in current situations, will do whatever it can to maximize production. Mexico, opening up for foreign investors, will they offer better and more attractive terms with $40 or $50 oil or with $110 oil? Iran, if the sanctions are lifted, will they be more accommodating to foreign investment to get it up fast at $40 or at $110? So these are the things.
All of these very large questions indicate continued volatility.
Yes, within it, the limits are set by the shale response, but it's only about 3.6 million barrels per day which comes from shale in a market which is now approaching, 88 million barrels per day. So anything which has the capacity to be of an order of magnitude of 1-2 million, whether that's Iran, whether that's supply disruptions or additional production from somewhere else, has the capacity to continue.
How did you vote, as a matter of interest here?
I voted with a tentative yes, but you know why?
Why?
Because the question is funny. When you express volatility in percentage terms, then a $5 change at an oil price of 30 is a much higher percentage than it was at an oil price of 100.
Right. Let's go to the next question, please, which is looking a little bit deeper into the question of volatility. What is the greatest uncertainty impacting oil markets currently? We've heard about in the news very heavily in recent weeks the outlook for China economic growth, which is clearly declining. Number two, today the US Fed is meeting and the interest rates could be changed today, although the forecast on that would indicate that they won't take that step. Three, OPEC maintaining and protect a market share strategy, as Christof talked about. Will OPEC hold the course? And four, Mideast conflicts, which are clearly a big issue in the neighborhood. Five being the inevitable undefined other, which could be so many other things. But what is the trigger of greatest uncertainty impacting oil markets? 10-second countdown, please. As you sit to trade every day, what keeps you most awake? Ooh. Interest rates, not of a concern, even though they could cause the emerging markets a lot of problems, not getting much attention. Other, of course, which is great, nobody's too interested in. But across the remainder, 32, the outlook for China economic growth remains very uncertain. And I'd like to bring in one of our guest speakers, Ben Simpfendorfer, who is an analyst on China. How concerned should the audience be about Chinese economic growth forecast?
Look, there's reason to worry about the long-term growth forecast, but I think concerns today are exaggerated, in particular by the stock market uncertainty. But really, this is generating a lot of noise, but not a lot of real concern about the economy. Indicators on the ground, defaults, layoffs are not at the levels we saw back in 2008. So let's recall that growth has already slowed from 12 to 8%, and the market has absorbed that. So a further slowdown from 8 to 6, I don't think is a major concern. But without a doubt, this is an economy that is moving into a subpar sort of medium-term growth trajectory when rates of 6% are very realistic. But a short-term concern, I think worries are slightly exaggerated.
I was in conversations at CIRA Week in Houston earlier this year, where one of the senior economists were indicating he was forecasting that China would be on a trajectory down to 3% growth, a sort of OECD average. Do you have any thoughts on that?
There is certainly an argument for that, but it's a medium-term story. So we've spent the last 10 years or longer bears in the market arguing that China is on the verge of collapse, and it never quite collapses. There's a tendency for the country to really extend that story out over 2, 3, even 5 years. So I would say worries over the next 12 months really, again, are exaggerated. Are we headed towards 3%? In the medium term, even the long term, absolutely, there are some major headwinds, particularly around demographics, capital shortages. But that's a 10-year story. That's not a 1-year story.
Okay. Christof, how did you vote on this?
I voted for number 3.
Number three.
But it brings something into the picture, which is indeed, it's not the question of China alone, it's global demand. Because we know, in theory at least, when there will be an endpoint to this period of uncertainty, when markets will be balanced again. And that will be the case when the increase in global demand is large enough to offset both the continued improvement for a few years of shale production in the US, plus OPEC production levels at whatever the desired level will be. That's some time away. Now, China, I think it's important to understand that this transition, what the Chinese call the rebalancing of the Chinese economy, away from one of the highest shares of the industrial sector in the economy the world has ever seen, towards more service sector, towards more decentralized, more light economic activities, away from export growth and tremendous investment and savings rates towards more domestic consumption. No, China is not the first country going through this tradition, from agriculture to industry to services. No other country which has gone through that successfully, that second stage from heavy industry to a more service-oriented economy, has done so without a significant slowdown in economic growth. And China will not be an exception to this. Economic historian friends of mine keep on telling me that indeed no other country has gone successfully through this transition without a major financial crisis. I haven't checked that, but it would be worthwhile checking.
You're indicating in your comments there that you think OPEC might blink.
Yeah, let me just finish the thought on
Okay.
China. What this transition means is, first of all, a shift in the type of energy consumed. Yeah, less coal, less growth in power generation, probably an effect of gas, but offset because it's so much cleaner than coal. Oil consumption, as far as it's used for transportation, is income dependent. So if the normal Rupus continuous growth slows down a little bit, but income levels remain relatively stable, we shouldn't worry so much about particular oil demand. We should worry a lot about coal demand if we would be in the coal business. Only if there would be a major slowdown, a major stop of this successful transition towards urbanization, more services, would oil demand be really affected. And I voted for 3 to answer your question, because I do think at the moment it is a question of it's a political question, it's a question of production decisions within OPEC, which sort of determine where the way we are going.
Okay, let's go to the next question, please, which is a forecast outlook for 2016. Where do we think oil prices are going to go? What will be the average price for Brent in 2016? Please, 10-second countdown. 30s, 40s, where do you see the average price next year? Not where it's going to end, but what will be the average price? Smack in the middle, in the 50s. So that's That would be a nice outlook comparative where it is at the moment. If we take the volatility question we had earlier and we take the 50s, it would indicate that maybe we will see prices higher and lower, but average in the 50s. If we could just take the last question.
It's beautiful, no? It really tells you, I don't know.
I don't know, exactly. No. This is perhaps one more pertinent to Fujairah. The price difference between front-month Brent and year forward has more than doubled since early July, when it appeared at that time that the contango opportunity was declining and ending, but now it's back up again. Do you expect contango opportunities to emerge and drive more demand storage for over the coming year? 10-second countdown. A year ago when we were in Fujairah, people were talking about Fujairah having too much storage. Now the question is, it is too little storage? Okay, finally an answer that is quite definitive in one way or the other, but your final thoughts, Christof, on this particular comment, the outlook being that contango continues to be an opportunity, Fujairah continues to be a very busy place.
I was in the first camp as well. I mean, for these 3.5 years of very high prices, I think all the time, except one period, we've been in backwardation. So the market telling us, so it's not worthwhile keeping it in storage, buy and sell it now. In fact, keeping it in storage was penalized if you have future prices below prompt prices. Ever since prices came down, we have been in contango, very reasonably high contango, with the market telling us, get some, if you have, get some storage, keep the oil there, because future prices are higher than prompt prices. And I think we had the head of the port here, and he will be happy, I think, that this may continue as long as this current period of uncertainty continues.
Well, it certainly seems to be a positive outlook for Fujairah, and as Gulf Petrochem recently announced this week that they are increasing their storage capacity in Fujairah by 50%, that would be quite positive for the outlook of Fujairah. So I'd like to thank Christof Rühl from ADIA for your thoughts and comments this morning, and hand back to Diala. Thank you very much.